Will Rowson, partner at Hodes and Associates. We do two main things. One is raise capital around the world. Last week we had, I was in Israel, colleagues were in South America, China, Copenhagen, take your pick. So we sort of scour the world for capital for specific clients. The other thing that's a fairly strong trend in the market at the moment is selling businesses. So we're involved in sell-side M&A. There was a fairly high-profile one recently that we were involved in. I thought the presentation we've just had was excellent. It followed a lot of the themes that we've been looking at, housing in Europe, certain amount of value-add investing around the world, alternatives. Fully agree that the alternative sectors are small, and yet they're niches that investors want to get into, but they're not going to solve the major problem of getting capital out the door when you've got, I don't know, inflows of 50 billion a year or whatever some of the largest global diversifiers have. But anyway, we're scouring the world for capital, let's put it that way.
Great. Simon.
Simon Mallinson, I run real capital analytics in Europe and Asia. So RCA, which is Matt kindly used a few of our slides. It's always good to see someone else presenting numbers. So our business is tracking deals around the world, deal by deal, property by property. We operate capture data on about 170 countries worldwide, all the sectors that a sort of institutional investor would focus on, and we're constantly surprised how the volumes keep going up every year, but it's good for business.
Josh Short of Internos. It was founded 10 years ago. We've ended up being a sort of 3.5 billion AUM firm in Europe. We were recently sold to principal global investors of the US. We have 80 institutional investors in various of our products. Mostly, interestingly, European investors, because a lot of what we do has been core and core plus. I also sit on the board of Great Portland. I've done that for 11 years, and I'm deputy chairman of Annington, which is the terra firma-owned huge MOD MQE portfolio of UK residential.
Great. Rasheed.
I'm Rasheed Hassan. I run Savills cross-border investment business. We, like Weill, travel the world trying to find money and selling Savills product to the global market and buying assets for the global market as well. A lot of our focus is moving money from east to west, so Asia, Middle East into the European markets and to a degree into the US markets as well.
Let's start with you, Rasheed. And in terms of the changes, I guess, let's look back over sort of 12 months. What are the big changes that you've seen in terms of capital flows? You can start globally and give us a view on Europe, but what are the big changes that you can see?
I think the biggest sector of the biggest market that is changing and evolving, well, two of them actually. One is Korea, South Korea. This is incredibly flexible capital to a degree in that it will look at all sorts of markets, but it is entirely focused almost on one thing, which is a 6.5% cash-on-cash yield. So this market, this source of capital has really it started in the UK in terms of outbound endeavours in 2010, 11. It was very active in the market, along with Malaysian funds, and that capital went away from the UK. It was busy in the US in 2016, incredibly busy in mainland Europe, but did nothing in the UK. That market, as it chases this elusive sort of 6.5%, has started to refocus on the UK. So that is simply a yield chaser, and I think that the function of finance and debt we haven't talked about. Matt didn't touch on debt, but it's something that I think is driving a lot of this capital travelling is where it can achieve the cheapest debt rates, and the cash on cash is almost more important, or certainly as important as the property level yields. The second market I think is really one to watch is Singapore. So all of the sectors that Matt highlighted as alternatives, as sort of hard to chase, that money is chasing those sectors very hard. They have specialist investment teams at home that do this, and they're looking at Europe very, very hard. The Singapore market also has a very active REIT structure, whereby they have an investment team, or they warehouse investments, and they have a REIT team as well. And the Singaporeans are looking very heavily at Europe at the moment at what assets they can REITify effectively on the Singapore Stock Exchange, and that money is becoming more flexible and trying to find spots across Europe, including UK, to do that. And again, they're looking at cash-on-cash returns 6.5% plus. So that number is a very important number for Asia, that cash-on-cash.
Okay. Just in terms of Will there mentioned the ability of investors, so let's take those Singapore investors, but let's also look at other geographies who are looking at Europe to get into those alternative sectors. Josh, how easy, how difficult it is? I know you've been setting up funds targeting some of those areas. How easy is it to therefore be able to actually put the capital to work in those sectors?
Well, I'll just start by going back to what we've seen in terms of changes. I think Hong Kong billionaires buying huge central London buildings has been a sort of phenomenon of 2017, and I think it'd be interesting to see if that does or doesn't continue. I think that's led to other sort of high net worth investors looking at real estate, either individually out of family offices or aggregated by money centre banks or wealth managers. And Van and I were talking earlier, I think that's sort of an increasing theme going forward. I think Japan, interestingly, is sort of waking up again. I mean, people who are in this room who remember the Japanese were massively active here in the late 80s and early 90s, and really, apart from Mitsui Fudosan and Mitsubishi, and maybe Kojima, haven't really been that active. We're hearing a number of big institutional investors are now back looking at Europe. So that's interesting. And then fourthly, Latin America. We took our first investor out of Latin America into our core fund. And I think we'll see increasing flows of Latin American money. We also act for a Brazilian family, interestingly, in Iberia, buying retail. So that's that. On specialist sectors, I think, look, it is incredibly difficult to get into because obviously they're operational businesses. And in my past, I've done Sunrise in assisted living, I've done Big Yellow in self-storage, I've done Blue Space in Spain in self-storage. I think you've got to pick the operator. It all stems from the operator, and then you work from there. I think obviously a lot of sovereigns are now coming in and disaggregating managers by basically doing these deals themselves. GIC, CPB, IB to name two. So that's quite an interesting phenomenon. We do hotels with a pool of 7 German pension funds and insurance companies. They're in our first hotel fund. They're now in our second hotel fund. Our second hotel fund is more value add than it was the first one, which was core, because 5-6 years ago we were buying hotels at 7. They're now sort of 5 caps. So we're taking those investors, if you like, on a journey from core through to sort of value add, even quasi-opportunistic, which I think is what some managers are doing at the moment. Clearly, some managers are going the other way. So that's the juxtaposition of what we're seeing at the minute. But there's clearly, for European investors, which is our main investor base, they want lowly levered, core, income returning funds, low risk, defensible, long dated, AAA cash flows. That's really what they're after at the minute.
Okay, good. Will, just want to pick up what you're seeing as if there's any trends that you've seen particularly over the last 12 months and ones that are coming up. Mm-hmm. And also, we've got a few questions coming in, so thank you for those. One is just in terms of maybe the risk side of it, some of the just in terms of Chinese investors, corruption issues, is that going to scandals, that kind of thing? Is that something that's going to impact on investment? And I'm also thinking a little bit about what's been happening in Poland with the South African money and arrests there in Poland. Is that something that you think is going to come more into the headlines maybe, and is it going to have an impact on actual investment?
How many questions are in there?
That was a lot, Will. That was a lot. I accept that.
Let me pick up on the global capital trends because I can cover kind of China at the same time.
Yeah.
Obviously, there was a bit of a break. Well, that's an understatement. Other than the large private deals that were done in London last year, a lot of the state-owned enterprises that had been very, very active, the Ping An's, China Life, etc., have come under the government control. And you've seen the Anbang scandal, whatever you want to call that. I think that's scared the hell out of a lot of those sort of corporate executives that were probably 2 or 3 years ago enjoying themselves around the world. So that's put a big break. Having said that, there's some private money that we've seen in the City of London, but also private money looking at other sectors. We've got a meeting later this week with a large Chinese group looking at housing in London. So they see that the need for £300 to £800 a foot housing, commutable distances in London. They feel comfortable here. Some of them have been educated here. So there are the reasons why this market still makes sense. I agree to a certain extent with South Korea. We haven't mentioned debt at all, debt investments, debt funds. There was a big sort of trend of South Korean money going into debt funds, seeking the kind of returns you were talking about, but getting it in, as they see, a more defensive way out of debt funds. We still see that to a certain extent. We see a lot of American capital going to debt funds right now. Let me deal with alternatives. We've done a couple recently. Laboratory space in the US, far bigger market than it is in Europe, far more sort of agglomerated. And there are 2 global diversifiers going into a joint venture that we're setting up in the US around lab space. Built to sell housing, just raised some capital for a group in Ireland because Dublin, nobody's built anything in Dublin for 10 years. And the GDP at 3+ is growing that economy very quickly. PRS in the UK, we had a long look at PRS in the UK a couple of years ago because we had managers coming to us who'd set up funds and couldn't raise capital. And our conclusion to that was, at the time, particularly for the longer version of PRS, the returns weren't high enough for investors, certainly outside Europe, to take the risk on the returns they were going to get, currency risk, etc. So the capital pool for PRS in the UK, long-dated PRS in the UK, was smaller than the market assumed. So we kind of we may still end up doing something in that, but on a slightly short-term version, i.e. development. So the Josh very quickly covered new source of capital. As I say, I was in Israel last week. It's not necessarily new, but it's busy. Latin America, again, we've taken some clients around Latin America. Recently, there's a lot more maturity in the institutions there than there was. So they're beginning to look outside. And again, Japan slowly is putting money out into the world. So let's hope they don't get their timing wrong. But I think they're going for the long-term game rather than the short-term game. But we'll see.
Okay, good. And Simon, in terms of, Matt picked up the idea there of interest rate rises, what might happen to bond yields. How much of an impact do you think that could potentially have? Especially, there's a question also just come in about US investors, and obviously you've got an interest rate cycle there that's slightly different to Europe potentially. Do you see that potentially having an impact on capital flows coming in, or do you agree sort of with what the discussion has been so far, that there's so much new capital seeking a home in real estate that actually those things may not have an effect in 2018, 2019, let's say?
So the easy question, interest rates. I'm going to cover interest rates in a moment, but just a couple of follow-up points to what. First of all, have you trademarked Retify? Because I'm going to use that one. Is that? No? Okay, Retify is a good word. But I think I'd pick up on one of Will's points about You said slowly, which I think is a big issue. The South Koreans and Singaporeans in particular move very fast, or they have been doing recently, and they've been able to deploy capital reasonably fast in this part of the cycle, because you need to move fast, you need to get, have fast internal decision making to get the deals done. And I think the Japanese are going to struggle, I think, because at the moment their processes are slowly, and it's going to be difficult to deploy the amounts of capital they want to deploy, as I say, in this particular cycle. So I think that's going to be slow seeing that capital emerge, particularly in an interest rate cycle where we're starting to see an impact from that in the US. The US is a good example. I think Matt referred to looking at the UK, what happened in the UK, to what happens in Europe. I think we can take that a step back and say, well, look at what happens in the US, and that then affects the UK, which then affects, you'll see a similar trend in Europe. So, and the US has started to see that interest rate cycle start to come to an end, or start to, I guess, not come to the end, but actually reverse and start to sort of rise a little bit. It's not a one-to-one impact, so basis point rise in interest rates is clearly not having the same impact on real estate, but we are starting to see investors in the US. The US in general was down about sort of 10% last year in activity, although Manhattan was down about 50%. But the gap and spread now between interest rates and real estate yields is so narrow that it is making investors think again about sort of what they're going to pay. So I think we are going to see that. At the moment in Europe, we're not really seeing that cycle rise. But certainly, if the US is the example that they're starting to see sort of unwind sort of the interest rates. Start to sort of rise a little bit. We're going to start to see that in the UK. We're going to start to see it in Europe to more degree, and it will start to put pressure on the spread. But as Matt's charts show, there's still quite a bit of room between historically very low interest rates and where real estate yields are. So it's I think there's a little bit to play in that. I think at least unless there's a significant change in interest rates in the next 12 to 18 months, I think we can see that the next 2 years that spread is going to be reasonably robust between the two. So I don't think it's going to have a huge impact. But when you look at a market such as Japan, there's clearly sort of they have a different view on interest rates, and I don't think it's as much of a concern to them about sort of that cycle around the world, just given sort of what they've got at home.
Okay, good. And Rasheed, in terms of the investors that you're looking at, the capital flows that you're tracking, are you seeing any sort of nervousness around either political risk in Europe especially, or whether it's interest rate rises or foreign exchange? What are the things that investors have got in their mind when they're thinking about, do I invest in Europe?
I think that in terms of political risk, you need to look at what's happening in the markets that this money is coming from. So, Middle East, major political unrest, which has been happening for a number of years. It doesn't compare with what potential changing governments, etc., or Brexit. It doesn't come close. And so, in terms of push factors for that money to be coming out, I don't think it's a major consideration. Likewise, China, Greater China, Hong Kong, the money wants to come out. The money wants to find a new home. Now they're looking for safe haven markets, and I don't think that anything that's happening in the EU, or frankly in the States actually, is sufficient enough to deter it. The big thing that interest rates again, I mean, the interest rate argument, if you look at Asia in particular, and the rates at which, I think if you talk, in particular I'd highlight Hong Kong and actually Japan, the rates at which these investors are borrowing at, it's actually far more domestic driven. So we're doing deals in London where your average investor would be borrowing at 2.5% to 3% for a core asset, whereas a private Hong Kong investor can be borrowing all in at 1.5%. Now they're doing that, they're putting parent company guarantees on their debts. That's a very normal modus operandi in Hong Kong. That means that the spread, if you're buying the asset of 4.5%, is huge. And likewise, Japanese investors, we just heard of a deal where they borrowed all in sub 1%, and at decent leverage rates as well. So there's a lot of room to manoeuvre there. The big thing relatively big thing that is currency. and obviously the pound has been very low, which has been a driver for pricing. I think it's pricing more than desire. It just drives how aggressive these groups are. Likewise, currency is a big issue with Sol. The carry that they're doing, the currency carry either provides a positive or a negative premium, and that drives their 6.5% cash on cash. Can they get it or can't they get it? If they can't get it, they'll go to another market. So if that starts to close, it will be a factor. And likewise, I suppose the Singaporeans. So currency is an issue, and also for the Middle East as well. I mean, it's like Hong Kong. It's dollar pegged, and so it's a factor, but it's not as big as the push factors that's driving the money out.
Okay, good. Josh, just a couple of things. One, we talked a little bit about China and Chinese investment, and I'm just wondering whether we had Macron in France pushing back about the Chinese investor being able to take essentially control over Toulouse airport. Do you think that's the start of governments beginning to push back a little bit on that sort of international capital buying into those kinds of assets? What's your sense of that?
No, I don't think so.
Okay.
I mean, I remember when the Mary Quarters estate in the UK was sold to Nomura in 1995, and there was some, political outpouring about the nationality of the investor. But I think by and large, we had America, I think under Bush, stopping, I think it was the Qataris buying into some of their ports in the eastern seaboard of the US. I think these examples are pretty rare, frankly. So Macron with Toulouse Airport, I think they're sort of rare events, and actually most major global economies welcome overseas capital from most jurisdictions because that's what they want. They want inbound overseas, FDI. So no.
Okay, good. And just picking up on that point, and one of the changes that we've been looking at during the Outlook series is, for example, whereas 2 years ago, looking at somewhere like Budapest, most people would say Hungary, no, not really going to go there. Whereas now that's completely changed around almost. Do you think that's related to comparative risk, political risk, that now Hungary doesn't look so bad, or a chase for yield? What's your thought on that? Do you think investors are beginning to open up more, like Matt said, in a way, in terms of secondary locations, that's also meaning that there's more of a drive towards different countries, different cities that investors may not have looked at?
Yeah, look, I think the deep liquid markets of Europe, and everybody will remember what happened in 2009-10, these markets like Hungary, Poland, even Spain, actually, completely, there were hardly any transactional volumes at all. But of course, we're in a position at the moment where the deep liquid markets are incredibly expensive, very competitive. So it's not surprising that investors are drifting into CEE, Northern Europe, and other locations. It's inevitable. I mean, we did buy a hotel in Budapest 3 years ago, I think, for our Hotel Fund 1. It's actually performed extremely well. I think logistics, Matt talked about, I think logistics in Poland, Czech, possibly Hungary, where, the hourly cost of, hourly cost of labour is sort of €9 fully costed, was in Germany it's sort of 36, in France it's 38. So, areas like that, people will move in. I mean, occupiers will move in, so capital will move in, because relative, when it's a low margin game, these are great places to operate logistics facilities in the middle of Europe, close to Germany, So there's a number of trends that people are picking up. But of course, if we have a Lehman event, I mean, I don't think we will, but if we did, clearly the liquidity in these markets will completely evaporate and dissolve. And yields will blow out 300-400 basis points overnight. So that's what you've got to worry about, basically.
And Will, are you seeing more appetite in terms of funds being raised for these kinds of areas? I mean, are there now any geographies? Is Russia and Turkey completely out still? Greece, is Greece now back? There's a question in about Greece. Are more investors beginning to look at some of these places that maybe they'd not been looking at before?
Look, we definitely see people trying to raise money for what you'd call secondary markets or fringe markets. We saw the first Greece fund recently, South, I can't remember what they called it, Central and Southeastern Europe fund. Now, there is potentially money out there. For us as a business, we don't take raises on like that because we think they're too risky, but that's not to say that there aren't buried in the world investors that will take on that risk. I fully agree with Josh. The big lesson I took from the GFC was don't be caught in a market where you have to sell when there's no liquidity. And the markets we're talking about, the tide goes in and the tide goes out. When the tide goes out, there isn't a great deal of liquidity, if any. So you take your return, and you have to look very closely at the risk you're taking when you take that additional return. So it's there will be mistakes made in this cycle, just like there were in the last. It's guaranteed. You just want to try and avoid them.
Okay, good. And a question has just come in as well on slightly on the regulatory side, which is if the government has an intention, whether it will achieve it or not, to get full disclosure on SPVs, is that going to put off some capital? Is it achievable? Will it have an impact?
Yeah, that's a very relevant one, both here and in the US, and I think throughout Europe, actually. You saw the French sabre rattling about Luxembourg 2 or 3 years ago. I think as long as investors follow a trodden path with regard to the structuring, for instance, international capital going to the US, going through the Cayman Islands, that is a well-trodden path, and if that was shut down, then that would stop a hell of a lot of money going to the US because of the FERPTA regulations and sort of ways of mitigating that risk and that tax burden. So follow a trodden path. Don't, if some smart accountant comes up with a new idea, be very careful.
Okay, good. And in terms of the regulatory side, Rasheed, how important is that in the minds of investors, particularly when they're looking, I guess, at Europe versus other areas? How important is the rule of law, particularly if you look at the UK, and how important, I guess, is consistency? Because if you could have a sudden political change, which could change some of either the tax rules or the regulation, how important is that in the mind of the investor, just the consistency or the rule of law?
I think that is important. I think that one of the reasons, I think one of the questions you asked or was raised earlier was why the UK has attracted so much and why mainland Europe doesn't or hasn't. One of the reasons is the UK legal system and the transparency of that market and a perceived sort of consistency of it, I suppose. So that legal system is important. It's comparative to markets in Hong Kong, in Asia, a lot of markets in Asia. It's important. People are looking for safe haven investment, and so anything that's perceived to be destabilising or rocky is something that they're not going to be that attracted to. But I think it's safe to say that most of the major Western economies have got pretty. But there may be a political change. There may be it might move from Conservative to Labour or a Socialist to party, but I don't think that's the major driver. I don't think it's a major driver.
Okay, and a quick one specifically for you, actually, which is what currency was the 1% debt that you mentioned, and how do investors deal with currency risk?
That was yen debt.
Yen.
Yeah. I mean, when you leverage in the target market, then ultimately you are part hedged. The balance. If you're an institutional investor, most institutional investors we find would say we're not currency speculators, we're property investors, so they will hedge out as much as possible. They'll hedge as much as possible, certainly the capital and then partially maybe some of the income. Private investors we see often take a bit more of a flyer on debt, and that will be part of their investment rationale.
Yeah, go ahead, Justin.
I'd also say, interestingly, there's a sort of pickup at the moment, UK Europe. If you can access, and Internos bought Commerzbank's Real Special Fund business in 2013, and that's a BaFin regulated business, and German banks will lend into that. I mean, still today it's sort of 1.2 all in. We bought a hotel in Malaga last summer, and we got 1.2 all in on a Spanish hotel. 50% LTV, bullet loan, 5-year maturity. So actually you can, and there's no way you're getting margins like that in the UK, and it's probably more like 2.5, 3. So if you do have access to the German debt, often in these BaFin regulated KVG structures, or you're a German borrower with a special relationship, actually German debt around Europe right now is incredibly competitive.
And is that generally true in terms of availability of debt for the majority of things, let's say outside development, that debt is there and getting lower in terms of more?
Well, I think in the UK, no. The people in the room probably more qualified than me, but I think the UK, I think the availability of debt from the big banks, certainly margins have gone up. I think for development it is difficult still in Europe in particular, but I think if you've got access to this German debt, at the moment there's no signs that those margins are going up.
Okay, good. Simon, just in terms of the UK, have you seen? I mean, we saw Matt's slides there about the impact of Brexit. Have you seen more capital beginning to head towards continental Europe, or have you seen anything in terms of the UK where capital is beginning to head maybe more to areas where there's manufacturing that's likely to lead to exports? Have you seen really anything that picks up that idea of where the UK will be in the next 2 to 5 years?
Yeah, we've certainly over the last 12 months or so, we've seen a big increase in UK-based investors going into Europe, into continental Europe, which the UK investors have been very quiet in Europe in this cycle so far, until 12 months ago, and they probably, it's probably 100% increase in what they've been doing, and whether that's it coincides with the Brexit decision, which I agree with Matt's sentiments on that, but it also coincides with the UK reaching a peak in its pricing. So there's two push factors that could be at play there. So yes, we've seen the UK investors go into Europe more, so maybe spreading the risk out a little bit. At the same time, in the UK, I think London last year, London was hugely flattered by the two big skyscraper trades in the Cheese Grater and walkie-talkie trading. That flattered London's numbers hugely. If it hadn't been for that, I think London would have been there were a lot of different stories talked about, so the amount of money flowing into London. As it is, the deal volume in London was down, I think somewhere almost 15% down last year in terms of the number of buildings traded, which suggests that there's a weakness there in the market, and also the trades of small buildings was down quite notably. So London certainly saw an underlying decline, even though the volumes flatter it a little bit. But the rest of the UK actually saw some positive sort of movements. So the big six markets, we have a price indices series, and the big six markets were, I think, third in terms of price movement last year. Sydney was number 1, Hong Kong was number 2, and the big six markets combined in the UK, excluding London, was number 3. So they certainly saw some very sort of positive price movements in the UK. The UK institutions have moved out to the regions quite a volume, particularly outside of the big six as well, and they did their lowest percentage they've ever done, lowest percentage and absolute numbers in London last year. So certainly the rest of the UK, to give it that broad term, is actually seeing a lot of positive investment activity, and even from some foreign investors as well. We're not just talking UK institutions here. We're seeing foreign investors go to the other parts of the UK. Whether you can tie it to manufacturing, I'm not necessarily, because certainly I don't think Birmingham was up somewhat, but I think the others, it was Bristol, Edinburgh, Glasgow, Leeds, Manchester. I wouldn't necessarily classify them as manufacturing hubs as such, but certainly, it's certainly we're seeing sort of a positive movements outside London.
Okay, good. Well, I just want to pick up the kind of theme of cities there that Simon was talking about. Do you think there are going to be some big winners? I mean, obviously we were in Frankfurt, Paris, Bucharest, Milan, Stockholm, Madrid, all of whom thought they would be the big winner of 2018. What's your sense? Are there some cities that are better positioned than others, whether that's Berlin or any of the UK cities, university cities? What's your view on it?
I'll just finish off on the UK because I think we are seeing US money got nervous about the UK, and I think slowly but surely some of the investors there are beginning to realise that actually if there's a weakness in a market, i.e. the investment market anywhere in Europe at the moment, it's in provincial UK, and maybe there's some returns that can be made there that you couldn't get in Germany at the moment. So I think these trends take a while for people to get in their heads and log away, and we're just beginning to see that. Some of the US investors are beginning to say, is there an opportunity in the UK? Because they're beginning to realise that actually, hopefully Brexit will be a fudge, and everybody will come out of it okay. So just this is an issue. The most fascinating thing I saw on your slides, there were loads of fascinating things obviously, but one of them was that Paris was down minus 41% in investment. And look, if any city stands to benefit from Brexit, it's got to be Paris. Shouldn't investors be piling in there, and piling capital in there? Clearly they're not, or they're not yet. And I think, unfortunately, and apologies if anybody's French in the room, I think that's still the perception from the world, that it's a difficult place to operate in. And, be it a business I used to be involved in, our Paris office was always the hardest to run. And I think that is a perception. Maybe it's wrong nowadays, and I think it affects investors' views. I think there are bloody good opportunities in Paris, probably elsewhere in France. But that perception affects the investment into that market, I think, anyway. But Berlin, I mean, if you go to Berlin now, it's going gangbusters, isn't it? It's pretty incredible. So I think, but having spoken to one of the expert managers in Berlin, they're finding it hard to find value there because the flood, even with their expert local knowledge, the flood of capital is seeping into the very lowest levels in that market. So it's quite hard. But yeah, I'd probably pick out, it's no surprise, Berlin as one of the top, and then possibly one or two of the UK cities, if you really know what you're doing at a slight sort of fringe level, if you really know what you're doing.
Okay, Joss, you want to speak that?
Yeah, I was going to say, if you look at listed markets, which sometimes are a precursor to unlisted, the listed markets are very keen at the moment on companies with office exposure to the Nordics, Berlin, Paris and Madrid, interestingly. They're obviously risk off for the UK, so GPE, Derwent, Lands, BL, others are trading at significant discounts to NAV, which is a real conundrum given the activity and the yields that were achieved last year in the sale of central London offices. But I think there's a view that possibly might not continue into 2018. And then in terms of themes, the listed market loves logistics and would love more student accommodation and seniors and self-storage type REITs, to your point. So, at the moment, that's where listed markets are sort of playing in Europe. And definitely Europe has seen, relative to the UK, as a better place to be right now from a listed perspective. Is that Brexit? Is that cycles? Is it probably 2 interest rate rises in the UK this year? I don't know. Is it all of those? Possibly.
Can I just pick up
Yeah.
on that? I think if you are an owner of assets already in some of those markets, so Paris, Madrid, Berlin, there is a perception of rental growth that hasn't come through yet. So underlying rental growth potential. And so that is explaining in part why the yields are so low. In terms of entering those markets, though, and Paris in particular, if you want to go into core Paris at the moment for a reasonable sized deal that is not discounted due to volume, then you could be looking for the very best at sub 3%. Likewise in Berlin, and frankly even in Madrid, you've got yields in the threes. So I think that's quite a mental hurdle for people to get over in terms of getting into the market now. If you're already an owner of assets, and I think there will be good performance. I think the comments about the UK, London in particular, volumes down in terms of numbers of deals, perhaps. I actually don't think that the market was so skewed by the two skyscrapers. I mean, they're $1 billion each in a 20 billion market. It is obviously, and they are needle moving deals. But the weight of capital that we speak to, that wants London as number one on their list, is, I mean, it's like tenfold to the inquiries that we get from mainland Europe. And why the question about market access, one of the issues, apart from the yields, which are at incredibly low levels in these cities, and small interest rate movements when you're that close to where the financing rates are going to be more sensitive, whereas in London you are looking at really 4 to 5% for best-in-class buildings, taking the Mayfair townhouses out of the equation. I think that the other issue is domestic funds. So the Paris market, and France, Germany, and Spain, or Madrid, Barcelona, there are so many domestic players who are incredibly active, and if you are a first-time buyer from overseas, it's hard to get picked as the top bidder. You're going to have to be outbidding by quite some margin to outbid to be chosen over a French insurance company. Whereas in the UK, in London in particular, you've got an 80% overseas market share. Everyone's used to dealing with foreign investors, and so there may be an appetite. The appetite's not there for Paris. It's very hard to compete.
I was just going to pick up the Paris point and just say, really supporting what Will said, in the sense that, the Q1 to 3 last year in Paris was the weakest we've seen for a long time. Q4 was almost the same total as the other 3 quarters added together. So suddenly we saw a lot of deals that were pending for most of the year, so they were in contract and hadn't yet completed. We had the largest amount of pending deals we'd ever seen, and suddenly they started completing Q4, when I think people got over the initial concerns about the political change in France. And I think when we look at the sort of the pipeline in Q1 for Paris as well, it's very strong as well. So there's certainly investors started pulling the trigger in the final quarter last year and started doing those deals. So I think Paris will see this year as one of the strongest markets. And you look at some of the intention surveys that have done by ULI and INREV, Paris office in particular is at the number one spot in those surveys. And whether you can deploy what you want to do is another matter. But certainly the pressure is there, and it's the weight of capital that drives pricing, and not the deals that have just been done. It is the bidders who lost out on the deals that drive the pricing up.
And certainly the session that we had in Paris, they were very keen on showing that the fundamentals there in terms of employment and people moving still into Paris, and to a certain extent a lack of supply, were likely to drive up rents. So, I mean, they were very bullish on increasing rents there for definite. One quick question for you, Rasheed, which is, if you've got investors who are looking for 6%, cash on cash for shopping centres is above 6%, so why aren't they buying them? That's a question that's coming. So what about shopping centres? What about the sectors, I guess, for those investors?
Retail is a hard theme at the moment, as we've heard, and I think shopping centres, you have to be very, very hands-on. So you've got to be a specialist. Whereas you can buy, an office block or a piece of logistics that's let to one tenant for a very long time. You hit the cash on cash, and it's an easy. If you are sitting in another geography, it's not a total headache to manage it. Whereas managing a shopping centre is just a much harder question. I think that where retail warehousing was touched on, I think retail warehousing is actually a piece of the retail market that you might see more of this overseas money coming into, because it tends to be fewer tenants, it tends to be long leases, and while it is obviously all these sectors are specialist sectors, it is more hands-off than a shopping centre with 50 tenants. The sectors that are most popular for that's if it's say Korean money, it will be office and logistics. Maybe multifamily in the US. If there was a real PRS kind of market in the UK, it would absolutely be there. But the returns are too tight. Possibly German multifamily is maybe slightly better yielding. Maybe there'd be some money for that. The Singapore money would be slightly more flexible. But the real areas are office and logistics. And that's moving, say, for Singapore in particular, into business parks as well. We've seen massive trades in the business park space, and we will see many more there. And the Korean money looking at regional offices, you can buy, Manchester, Birmingham at 5% plus, and you're buying best in class buildings, let's good tenants at and you're well in excess of your 6.
Okay, good. Will, one of the big things from this year, I think, has been investors coming in, capital coming in and buying platforms. Do you think that's because of the undoubted expertise of the managers? Or is it just that it's very difficult to access assets, and this is an easy way to be able to actually allocate a substantial amount of money into the market in a relatively speedy and efficient way, and obviously access the expertise of the manager?
You're onto the wrong person, aren't you?
Well, I wanted to get your view before getting Josh's patently.
There are all sorts of things at play in this, so it's not easy just to encapsulate. I think the number one is real estate's become more of a mature part of the investment sector. So you've got bonds, equities, and alternatives, and real estate's a big part of that. And so some of the big financial players in the world, financial institutions in the world, want a real estate arm. And so, I used to be part of ING Rhyme, and ING Investment Management used us, and we were the kind of 10% allocation down at the end of the corridor for real estate. 10 years ago, it was looked at like that. Now, I think real estate is more mainstream and slightly more centre stage than it was. So I think there's that at play. I think there's also a little bit of opportunism going on, where giving you access to markets where you think there's giving some of the maybe more private wealth channels access to markets. I think the earliest corporate deals, if you want to call it corporate deals, in Europe were done by more private money, and it's become more institutional money over the last 3 years. I mean, it's a huge part of the investment world in the States at the moment. And we've got a couple of sell-side mandates in the US, where actually people have turned around to us, been approached by European money, interestingly enough, and then asked us to advise them on selling themselves to European money. So there's some flows, sort of corporate flows that we haven't seen before, actually. I don't think there were, probably not since the early 80s or something, that European money going to the US to buy businesses. And that we've seen 4 or 5 of them recently sort of asking whether we can help out. So yeah, it's a ever-changing picture, but I think the main theme behind it is the fact that real estate's become more mature and therefore a more important part of the investing world, per se. Hopefully you agree, Joss.
Yeah, I think this is a massive subject, because you've got consolidation around the world in real estate and bigger investment managers. So, clearly Patrizia bought 3 platforms in the space of whatever it was, 3 months, to almost automatically propel them at 40 billion of AUM euro into the sort of biggest core plus manager in Europe overnight, which was pretty extraordinary. Principal that bought Internos, I think bought Internos because they were a $70 billion manager in the US. They've got big US client relationships, and a lot of those clients are in Europe with other managers, and so they'd been looking for a while, and there was a strategic and cultural fit with us. I think Tristan is again a slightly different story, and then you've got Generali Lendlease selling into Macquarie's infrastructure business, which is quite interesting. So I think there's all these sort of big global trends of consolidation, access, investors, and clearly the bigger investors are giving a smaller number of managers a huge amount of dollars. So Blackstone, Starwood, Lone Star, these organisations are hoovering up a lot of capital, and that's not to say that smaller players can do well. They can do very well, but if you're a sort of pan-European manager with, I'd say, 3 to 10 billion, you're sort of in that centre ground, which I think on a look-forward basis could get disrupted. Then you've got the whole regulation thing, MiFID, AFMD, GDPR. You mentioned SPVs, KYC. There's so much coming at an owner-managed business from regulators that just puts your costs up. And then I think the whole theme of platforms is it's a great way to access deal flow and pipeline and deploy capital in a rapid way. And people seeking best-in-class operators, particular sectors. In the US, development, a lot of people partner with developers in regional markets in the US. I think we'll see more of that in Europe, actually, on a go-forward basis. So there's so much going on in all of this, both thematic and structural. But anyway, that's my 10 pence.
Yeah, and you've also then got Logicor, P3, Trigranite. A lot of those also happening in a relatively short space of time, I think.
Yeah, look, I thought the sale of Logicor to the Chinese consortium, and now Blackstone allegedly buying back into it with their core fund. I think they're back at 25% of the equity in Logicor, is really quite interesting. So that's a whole nother theme where you've seen Blackstone, Ares, and others come down the risk spectrum into more core plus, from opportunistic to value add to core plus, and that's another huge strategic theme going on. And that was a huge trade, wasn't it? Logicor, was it 14 billion or something? 12.4 billion, thank you. Absolutely gigantic, but there was a number of buyers for that. So I think at the moment you can always aggregate a platform up to billions and billions and billions, even double-digit billions, and still be able to exit it, which is pretty remarkable, and privately rather than publicly.
And just quickly on a couple of some of the sort of overarching themes, Rasheed, things like, for example, 2 years ago, we weren't really doing anything on livability, wellness, even innovation and tech. Actually, we're only just beginning to come into the discussions that we were having. What's your sense about that? And also, I was interested to see BlackRock flexing its muscles a little bit on the gun debate in the US. Do you think some of these things do you think investors are going to become more aware of these issues, which would have been viewed as maybe softer issues, so things about how they're perceived, but also beginning to look at livability, wellness, as a way of protecting risk in terms of when they're looking at cities?
I think that amenity in buildings and this whole live, work, lifestyle, making great spaces for people to work is very relevant. And I think that's relevant. It's not to do with sort of CSR, it's to do with keeping tenants. And I think that's becoming a bigger theme. I think the disruption of people like WeWork, the office group, yes, they're disrupting from a serviced office and traditional leasing perspective, but what they're also doing is creating interesting places for people to work, and I think that whether it's in the service market or the non-service market, you create those sorts of spaces, and that is very relevant. People want. We just sold a building where they had, everything from an on-site beautician and it made a difference to the tenants. And when we were coming to sell that building, investors were interested in what we created there, or the investor created there. So yes, it's interesting from a temp perspective. In terms of how they're perceived as investors, I think possibly at the very, very institutional end of the market, maybe the sovereign end of the market, that might be a relevant factor. For us, in terms of the day-to-day that we're dealing with, it doesn't come up so much. And a lot of the investors we're dealing with, there's lots of private money in there. It's or the people looking at whether or not they can put something in a REIT, they're not looking at that kind of thing. They're looking at its return. It is a much bigger factor.
The ESG, green, just 2 or 3 comments. I remember somebody saying to me in 2007, 2008, I won't name them because they're a big European organisation, but they basically said, green is relevant until there's a downturn. And then my to-do list changes, inverts. I think we've gone beyond that. So I think that's one of the critical things that's happened in the last 10 years. ESG, impact investing, it's become far more relevant, and I think it'll survive the next downturn. It's gone beyond that stage. Just one thing in co-working, which I find fascinating. Everybody talks about co-working as being millennials and driven by that generation. Actually, as the baby boomers move through and people work longer and then retire later, more and more of the population, in fact, a majority of the population is going to be older, and they're the ones that co-working organisations have also got to look at to provide facilities for. Hopefully, millennials and those baby boomers will both want the same thing, but if they don't, it's going to be quite an interesting conundrum for those co-working groups. So you see a range, we did some work with one recently, and you see a range of ages in those. It's not just people with beards sitting there, sort of working on their laptops. It's a range of ages. It'll be an interesting one to see how it plays out.
Okay, good. I've got one last question. If you had to nail it down, what do you think will be the biggest trends for capital flows over the next 12 months? So when we sit at this table again in 12 months' time, we can see whether we're right. Rasheed?
South Korea, UK, up. China, outbound, down. And Singapore, mainland Europe, up.
Okay, good. Joss?
I think US money continuing to flow, and probably flows will increase, and more high net worth capital coming into the market, either in funds or separate accounts or just individual buying.
Simon?
Well, I agree with all that, unfortunately. I would also say, actually, partly to what some of the comments Joss was making earlier, I say this year and into next year we're going to see more public to private movement as that large weight of capital that needs to be deployed has to go that route, and we're going to see more. Maybe some of the specialists, maybe some of the big European platforms get taken private, given where the pricing is at the moment for them.
Okay, Will?
Can't really add a great deal. I agree with Joss. US money coming into Europe, they're behind. We're behind in the cycle in their heads, so that will continue. And yeah, I think we do more and more work with high net worth family offices, and there's an awful lot of capital wanting both direct and indirect from that sector, and I think you'll just see more and more of it being active.
Okay, great. Thank you. Thank you.